I'm honored to have a very special guest join us in today's episode, Jenny Harrington, a longtime dividend investor. Jenny is a regular contributor on CNBC and appears on the Halftime Report and Worldwide Exchange. She is also the CEO and portfolio manager at Gilman Asset Management. Hi, I'm Canaan Sarai, and welcome to the Simply Investing Dividend Podcast. Jenny started her career as an analyst at Goldman Sachs and has been quoted in major business publications such as the Wall Street Journal and Barron's. She is also the author of a new book, Dividend Investing: Dependable Income to Navigate All Market Environments. We talk about dividend investing, how to get started, how to become a confident investor, and how to navigate the current economic climate. Let's get started with this interview. Jenny, welcome to the Simply Investing Dividend Podcast.
Thank you for having me. I'm so excited to be here.
We are so honored to have you on our podcast today. Our audience loves dividend investing. I'm passionate about dividend investing. And so we've got lots of questions, lots of things we want to uncover today. Let's get started. And like I said, our favorite topic is dividend investing. So my first question to you is, what inspired you to write a book about dividend investing?
Um, so as so during the pandemic, I always try to figure out like, all right, do you give the whole story or do you just make it glossy? But I think the whole story is probably worth it. But during the pandemic, Josh Brown, who I'm on CNBC with, wrote a book called How I Invest My Money. And what he did was he reached out to a bunch of different friends and asked each one to write a chapter. And so I wrote a chapter in that. And the publishers liked my chapter and thought it was unique and asked me if I would write a book on dividend investing. And it's something I think every investor dreams of writing a book about their strategy. But it's probably never a good time because we're not professional authors and the market keeps us on our toes all the time. And, there's life and teenage kids and college searches and all that. But I thought this is my only chance where I'm going to have someone come to me and actually say, will you write a book about dividend investing? So I felt like it was an opportunity that I had to pounce on. It was funny because when I started the book, I found all these drafts of books and white papers that I'd started over the years. One of them was called In Defense of Dividends. It was very defensive. But that was really it. It was the publishers reaching out and me thinking, this is something I've always dreamed of doing and never thought would be a reality. And, you need to take opportunity when life hands them to you. So that was it.
Yeah, no, that's great. That's a great, interesting background on how you got started. Now, in terms of the dividend strategy itself, right? Because your background, you've got an impressive bio. Um, what interested you in investing in dividends versus there's tons of options out there, right? There's derivatives, there's day trading, there's crypto, and all this other options available to you. What attracted you to dividends specifically?
So here's another one where it wasn't me going out and saying I want to write a book, and it wasn't me going out and saying I want to create a dividend strategy. These things just kind of like, fall on top of me. So what happened for me was I had started in the investment business in the late 90s when it was all growth stocks, rah, 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 dot-com boom. In a lot of ways, it was like the environment that we're in today, where if you weren't making 100% a year, you were a loser. And that never resonated with me. And it didn't really sit well. Something made me uncomfortable about those numbers. And this was before I was an educated investor. This is before I'd gone to business school and really knew how to research stocks. But it felt crazy and kind of dangerous. So I moved in 2001, I left Goldman Sachs. I went to Neuberger Berman because I'd always wanted to be a portfolio manager and found myself on a team that was managing really like a S&P like portfolio. And I had one client call and he said, look, I'm 55. I'm getting ready to retire. I know I'm too young to retire, so I need income, but I also need growth. What can you do for me? And what I did was I took his plain US core portfolio and transitioned it. I said to him, well, why don't we just buy some dividends? So I transitioned it to still a core US stock portfolio, but with the objective of having a 5% or better dividend yield because it just made sense, right? It made sense. It was if he had owned bonds then he would have gotten the income, but he wouldn't have had the growth that he needed. The income from the bonds wouldn't have grown, whereas dividend income grew. But it was never this great, hey, I'm a visionary and I see that people need income. And I'm sure that for the next 25 years of my life, interest rates are going to do nothing but, well, 20 years, but go down. I guess, you know what? It is almost 25 years. I'm older than I realize. And so it was just responding to the need of one person. And it made sense for him. And it made sense for a lot of people like him because it turns out there were a lot of retirees. There were trusts where there was an income beneficiary and a growth beneficiary, but it didn't make sense to divide it up. There were foundations where there was a 5% income need. So it was just a pragmatic, responsive beginning that built upon itself because it served a need. And I think that's something that I've come to appreciate more and more as I've gotten older and as the investment world's changed, is many portfolios just try to beat the market. And that's pretty tough, particularly in a world that has been flooded by algorithmic trading and exchange traded funds. But the beauty of dividend investing is that it's incredibly useful and it creates a pragmatic utilitarian portfolio that provides the income that you've needed and you know it's coming. And again, unlike a bond portfolio, that income grows and it grows on average at a higher rate than inflation. So I've really fallen in love with the strategy over the 24 years of managing it because it's so useful. It actually does something.
Yeah, that is.
Rather than just play a game and beat an index, which is nice too.
Yeah, but that resonates so much with me and our audience, right? And I tell people all the time where the dividends is tangible cash. You can spend that money if you wish, or you can reinvest it. And without dividends, you're only hoping for the stock price to keep going up, and hope that it's going to be up when it comes time to sell. But hope isn't going to cover your living expenses.
No, and the way I phrase that and think about that too is presuming you've done your homework very well, and you've got a growth stock and you've got a dividend stock, and you're a good research analyst and you've done your homework, and you think, okay, this growth stock should return 10% a year for the next 3 years, and this dividend stock should return 10% a year for the next 3 years. But let's say the dividend stock has 5% of that coming from dividend income. When you're buying a dividend income stock, some portion of that return is certain. Whereas on the growth stock, 100% of the return is uncertain. You need that story to play out. You need fellow investors to behave in the manner that you expect them to behave in and the market to behave. But when you're buying the dividend stock, at least some component is certain. And that is awfully nice in an uncertain world.
Yeah, absolutely. And that brings me to one of the questions I had was, and I get that a lot from people who are not dividend investors. And so what they tell me is, if the company, anytime the company pays you a dividend, let's say it's a dividend of $1 a share, they say, well, the stock price drops by an equivalent amount. And if I ever needed any income, I could just sell my stocks and make money that way. So what's wrong with that approach or versus, taking in dividends?
So two things. I remember when I was I think it was in a security analysis class when I was in business school. And we learned that, like, well, when the dividend pays, the stock price drops commensurately. As it turns out, in the real world, it doesn't. That's academic theory. It doesn't really happen that way. And then to answer your really, really, really critical question or thought is, why not just sell the stocks when you need the income? You can. And that is a perfectly good way to do it for some people.
Yeah.
And I think you need to figure out which of those strategies sits better with you. And in theory, if you and I were before looking at a picture of Jeremy Siegel's chart from Stocks for the Long Run, where it shows stocks in the market cut by 5 deciles, and if you believe in mean reversion, right? If you believe that over the long run, all stocks kind of return 8 to 10%. The reality is it doesn't matter. If you have a growth stock portfolio and sell when you need income, or if you have a dividend portfolio and just get the income, like if on average they all return 8 to 10%, it doesn't matter. in the book that I wrote called Dividend Investing, that's one of the things I talk about. And you need to figure out what kind of investor you are and what sits well with you. And I think probably the reason you and I connect immediately is we need that certainty. So Jenny Harrington, I don't have the emotional bandwidth to think that it might be a March of 2020 and the market's down 35%, and I need my monthly income, and now I need to sell down 35%. I like knowing that it doesn't matter if the market's up, down, or sideways, the dividends are just plunking into my account. And that sits better with me. Now look, in a 2023 and a 2024, when the market's up 26%, it doesn't bother me that I'm not keeping up. But that does bother some people. And so for the people who that really bothers, maybe a growth portfolio and just responsibly selling when you need cash makes sense. For me, the value comes from knowing that the income that I need is going to be there no matter what, and I don't need to make an active decision to create that. That's what works for me. I think as I've been talking about the book and like doing more podcasts, one of the things that I never really thought about before, but have been thinking about recently, is how do you figure out what kind of investor you are? You and I know, but we've been at this for a while and we've had a lot of conversations, and I can go back to my rocky childhood, rocky financial childhood. And I can tell you exactly why I need to know that the money's going to be in the account every month. Right? That means a lot to me. My brothers who grew up in the same house, like they responded differently. The ups and downs don't bother them. They have a higher risk tolerance than I do. So I think you figure out who you are by conversations, by thinking things through, by reading, by listening, by watching this podcast, and then maybe watching a growth podcast and saying which one just feels right to me. But I think you can.
The predictability helps people to sleep better at night. For some people.
Right. Not everybody, though. Not everybody. Yeah. Some people, it doesn't help sleep better. Some people can't sleep because they missed out on the market being up 26% last year. And that kills them. My clients are like, what do I care? My income's there. So, it's just which one of those is going to let you sleep?
Yeah. So now we're talking about emotions that come up when you're investing, right? And you have an entire chapter dedicated to this called emotional comfort. So what does that have to do with investing?
Okay. Here's another kind of new thought that I've been having. I feel like this thought's been evolving in my head for a very, very long time, but I'm starting to finally button it up recently. For years and years, whenever people interview me about managing their money, one of the questions that comes up is, how do you mitigate risk? What do you do for risk management? And they'll ask me things like, do you use stop loss orders? Do you hedge? Do you use derivatives? Do you manage the portfolio's beta to blah, 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 blah? And I always say, and I've said this since the early 2000s, and I used to think it sounded silly and overly simplistic, but it was accurate. And now I'm like, no, it's quite profound. But what I used to say is the cash flow is the risk management. Because the cash flow, if you know you have it, and that's what your portfolio is there for you, then you don't have to sell, right? You don't have to sell when the market's down because the cash flow is coming to you. Like that is the risk management. But what I've realized, and this gets into the behavior, is the single biggest portfolio risk is bad behavior. The single biggest portfolio risk, I don't think, is not perfect at asset allocation. It's not buying a couple of stocks that went bankrupt, right? That's just going to happen and you're going to hit a few home runs too. The single biggest risk to a portfolio is not being comfortable enough that when it's March 2020 or March 2009 and the market's really bad, is not being comfortable and confident and secure enough in your portfolio that you sell at the wrong time. And one of the things that I mentioned in the book too, and hopefully Peter Lynch will listen to this at some point and tell me if this is a real story or not, but this may or may not be true. But the story I heard a long time ago was, there was the Fidelity Magellan Fund, which had some of the best returns ever. And they studied performance and they said, look, some huge percentage of clients have lost money. And Peter Lynch said, well, that's not possible. I know that I have some of the best returns out there. It's just not like, go back and study it again. And marketing came back, or whoever came back, and said something like the average holding period is 10 months.
Mm.
And that really, really said so much to me. And when I think about, the most portfolio destruction I've ever seen in my clients' portfolios, it's from bad behavior at the wrong time. It's not from it's not from the great financial crisis where the market was down 60%. It's not from the pandemic. It's not from me owning a couple of terrible stocks. I always make a mistake and have a terrible stock here or there. It drives my clients insane. Like they, of course, ignore the winners. But that's it. So I think this goes back to what kind of investor are you? And what I've found is knowing that the income is there brings tremendous emotional comfort. If you are emotionally comfortable, you get through the worst times. If you get through the worst times without selling out, your returns compound and significant wealth is created. So that's why I spend so much time on emotional comfort and figuring out who you are and what kind of portfolio makes sense.
Yeah, that is so important. And I loved
It's
hearing
the
that
most
story again
important.
that was in your book about the Peter Lynch story.
Do you think it's true?
I, I think so. It sounds like, yeah.
Let's hope so. It's such a good
I
story.
guess Peter can let us know if he's listening in. Yeah.
He's so cool if he actually did.
Um,
Maybe if I keep telling it enough,
yeah,
someone will say to him, like, hey, maybe you should, chime in.
that's right. Now, so behavior is so important. Do you think this is something that can be taught? Like, can people,
Yeah.
how does somebody become a more confident investor?
Okay. So absolutely it can be taught. The hard part about teaching it is that it takes what I don't know about Canadians, but I know Americans have become extremely poor at. Teaching good investment behavior takes time and patience. In
Absolutely.
short supply down here nowadays. So, and I think it's been in short supply for a long time. But I frequently tell my clients it's going to take you 18 to 36 months
Mm,
to get comfortable with
mm,
this. And what I need to do in that time period is be extremely consistent. So what I do is I write a quarterly letter, and it's comes out at the same time every time. Some of the themes are reiterated over and over. Oftentimes my partner Greg and my husband John, that's who I work with, and they edit and weigh in on the letter, and they'll say, you can't say this, like, oh my gosh, you've said this over and over, or I'll share a chart. It's this funny chart that I show that says your plan, and it flips upwards, and it says reality, and it's got,
yeah.
thunderstorms and hurricanes. And I say, and it looks like the market. But you share these things over and over and over, and they start to sink in. And it's my job for when the market's terrible, for my clients to know that I am writing them a note explaining what's going on beforehand. And that whenever a new stock goes into the portfolio, they get an explanation of why. And then we do a quarterly call. And I say the same kind of, here's what happened, the same format. But you can teach it. And it needs to be taught through consistency, consistency, consistency. And it's also taught, even more importantly, by getting through the rough times and having your clients come out whole over and over again. Whether it takes 36 months to come out whole, or a week and a half, however long. But that process of hearing the same thing over and over and getting through the tough times, that teaches you how to be a good investor. And there's no rushing that. There's absolutely no rushing it. There's no book you can read. There's no one book you can read. There's no one environment. It just takes time.
Absolutely. I agree 100%. And I think you have to go through that process. For me personally, the biggest thing was seeing the dividends coming in, right? So I've been doing
Yeah.
this for 26 years. So we've gone through the tech bubble burst, 2008, 2009, even 9/11 when they closed the New York Exchange for a couple of days, seen the market tank. But having the dividends coming in kind of built up my confidence a little bit, and then a little bit
Yeah.
more and a little bit more. And I think that's what makes you a more confident investor in the long term. But like you said, there's no shortcut here. It's going to take
Right.
patience.
Right. It's so interesting. And even as a professional investor for me, there are things that I'm still kind of, like the risk part. That's kind of new to me. I've always said this is how I mitigate risk, but it never occurred to me until fairly recently that the biggest portfolio risk is a result of behavior. That's pretty wild.
That's a big
And here's an interesting one on the same thing of getting through these tough times. I have this wonderful client who I adore who retired last year, and we've been working together, I think, for 11 or maybe 11 years now. So that means we've been through the pandemic. Okay, it's 2025. Yeah, so we've been through the pandemic together, where the market was down 35%. We've been through 2022, where the market was down 26%, 2018, where the market was down 20%. Before that, there was the energy collapse for a while in 15 and 16, and the market was down. There was US debt downgrade in 2011, Ebola in 2014. I'm missing a big one. Taper tantrum in 2013. And she's been pretty zen, this client, but she retired. And she freaked out 3 weeks ago. Freaked out. And I'm like, are you kidding? We've been through this. We've been through so much worse. And she's like, yeah, but I wasn't retired then. I'm like, wow, that's interesting. So now the clock starts over.
Now, you mentioned in the book, there's a story about Rick who asked you a question and said, are my dividends safe?
Yeah.
Right. So tell us about that. How did that, how did Rick sort of overcome his fear?
He didn't.
Well, he didn't.
That dude doesn't have any fear. That's the most zen. Like, this guy is the best. I've worked with him since 2001.
Yeah.
Obviously, his name isn't really Rick, but I wish I could. I should have just said, can I use your real name? And he'd be like, absolutely. I'm proud of that. Yeah. So I think it's interesting how often the non-professional investors are the best investors because they don't try to be too smart. They don't overly worry about if you're using stop losses.
Yeah.
But the story that I talk about in the book is absolutely true. And what happened was, this was a guy that I started working with in 2022, and his wife's mom had passed away, and they inherited like a reasonable size, not huge, just like a legit, I'm not exaggerating or under exaggerating, it's just a reasonable size trust. It was really nice. And they had two, at that point, high school kids who were going to become college age kids. And they set the trust up for income just to supplement, because they just had like normal people jobs, and it was a really cool gift. And this income was really nice, and it really took a pinch off at a time in life where, you're paying for school and all that. And so then we start going through and so at that point I'd worked with him 2002 to 2009. So there was a nice relationship in place, and there was a lot of trust built up over that time. And there were 7 years of knowing that those dividends were rolling in. So at the point where I'm talking about it in the book, it was March of 2009, and I was super pregnant, and it was terrible. And all through, the thing about the great financial crisis was it moved much more slowly than the pullbacks that we've been experiencing since then. And the recovery was slower too. But that thing crept down from October 2007. That's when the market was at its high, all the way through March 2020. So it's just, death by 1,000 cuts. And then there were all these nasty bear market rallies where you got a little hopeful. But by March 5th, 2009, it was ugly. The S&P was down 60%. And kind of up until then, I still had my, I'm a recent Columbia Business School graduate, I'm going to refer to market history cap on. And I call my clients over and over and over, because the nice thing about being in the training program at Goldman Sachs is they beat it into you. When things are tough, you don't hide from your clients. Like, communicate, get out there and stay in front of it. And I did. It was all I knew to do. And it was the only smart thing that I could do. And so Rick, right? So I call him, and I don't even know. It was so busy. I didn't even tell a lot of my clients that I was pregnant. And that wasn't intentional. It was just, that's how intense and busy it was. I'd be like, oh, by the way, I'm 9.5 months pregnant. But I called him up and I said, look, the market's down 60%. Our portfolio, I think, was down, probably pushing 40 at that point. And I said, at this point, I can't tell you with history as a guide. We are in uncharted territory. I have no idea what's going to happen next. And and he stops me and he says, Jen, is my income safe? And I go, yeah, your income's safe. And he's like, then I'm fine. Like, go find something better to do. And it wasn't until then that I realized the power of the strategy and why it was important. I think to some degree before that moment, I too was playing a game of, I'm going to be a portfolio manager and beat the S&P, and I'm going to be as smart as, the other nerds who, the other nerds who graduated from my Columbia Business School class, and we're all going to wonk out. And then in that moment, I realized, like, this isn't a game. This is a pragmatic endeavor to create income so that his life can go on. And, and I still see him and his wife every year for dinner, and we still laugh about it. And I just sent him a copy of the book. I'm like, this is your chapter finally, and so I guess going back to when you said, why'd you write a dividend income book? I think those stories are actually important for people to know. And that part of hearing that story is helping people figure out what kind of investor they are. But that was a super, super profound moment for me. And like, really, you know how it happens, right? Like, the profound moments come when you don't expect them and they're bite-sized. And then you just, reflect back on it forever. So, yeah.
Yeah, that's incredible. And you've got other stories in the book as well. I think somewhere somebody's going to read that and they're going to be able to relate to that, right? And it's going to help them hopefully become more confident investors.
Yeah. I find up until, you'll think this is funny, but up until the pandemic, I never did, how I said before, I do quarterly client calls. I never did those. I wasn't comfortable with Zoom or WebEx or whatever it was back then. And I never, ever, ever did a client event because I've found that over the years, I always end up telling my clients stories about each other. And I lived in fear of anyone, and I don't use names, and I change the numbers and I change the locations, and I never really did it intentionally, but I just found myself over the years always saying, well, people would say, well, how do other people do this? And I go, oh, there's this one person who does it this way. Oh, I have a client who's really interesting, and this was their experience, and it sounds like yours. And I found that over the years, being able to tell people other people's stories, it was incredibly helpful. But then I felt like I was in hot water where I'm like, oh, shoot. Like, if I ever had a client event, you'd be like, oh my God, I know that you cashed out on March 20th, you idiot, or like, oh, you're the one. So then during the pandemic, we got comfortable with Zoom, and now we do this client call, but everybody's hidden because they would still know. But all jokes aside, it's a weird business. People don't like to talk about money. They don't like to talk honestly. It's super, super, super personal. Like, you're way more comfortable talking about your visit with your proctologist or your OB, than you are about, like, well, I only have $2.5 million. Should I have 6? Or like, I just inherited 30 million and I don't know what to do. And it's so much, like, people are extremely uncomfortable talking about it. And everyone thinks, like, there's no sharing of information. So I found, like, sharing these stories is important to people. It just is.
Yeah, absolutely. It's so important.
I changed the names and details enough.
That's right. So my next question is kind of related to that. What advice would you give to someone who's in their 30s right now, has a day job, has not invested or saved any money? How should they go about investing for their future?
Okay, so I'm going to steal this answer from my beloved friend, Nancy Mayer. So my friend Nancy is really cool. She and I met at an MLP, a Master Limited Partnership conference, about 15 or 16 years ago. And Nancy, she's just an amazing person. She was the state treasurer of Rhode Island and then later became a portfolio manager. And just so you all know, Master Limited Partnerships, well, in Canada, you probably know what they are, but they're the oil pipelines, or they're the energy pipelines, not just oil, like, natural gas, liquids, blah, blah, blah. And they transport fuel. And so when Nancy and I were at this conference a million years ago, it was like, I don't know, I'm probably exaggerating this too, but let's say it was 1,500 people and, like, 6 of us were female. And Nancy and I sit down at this table together and have been friends ever since. And Nancy is a truly great investor. And the advice that she gives on that she would, give to her granddaughter well, first of all, it's just get started. And the beauty of investing now is you can go online to Schwab or Robinhood or TD or Fidelity or E-Trade. It doesn't matter, any of them, and you can open an account and you can put $50 in it. You could put $100 in it. It doesn't matter. So first of all, you just have to get started, and you have to get started. And the younger you get started, if you are 17 years old, get your parents to sign off on it, open the account and get started. But then where Nancy comes in, this is her advice, and I think this is really, really smart. She suggests that you put 80% of it into just a broad market fund. Because if you put it all into individual stocks, it's probably going to make you too nervous, and you might freeze up in your tracks, and you might not actually do it. So she says, look, I don't know, choose whatever. Choose the S&P. Personally, I would say choose the S&P equal weighted right now, and choose an international developed, and buy a little bit of that. But then she says, carve out 10 or 20%, so do 80 or 90% in two broad market funds, so you don't feel like the pressure's on you and you're just going to participate in the market. But then she says, carve out 10 or 20% and buy a stock or two that you care about. Because what happens is when you buy the stock or two, you start to care and you start to pay attention in a different way. And then this goes to, would you buy a dividend, a dividend income stock, or would you buy a growth stock? And if you're trying to figure out which kind of investor you are, buy one of each. Buy an energy pipeline or a real estate investment trust, and buy, I don't know, Palantir or Nvidia or, who knows, whatever. I'm not giving advice on buying those. I'm just saying, buy something that's a growth stock and see which one makes sense for you. But the only way you can figure it out is by doing it. And you can start today. And I think this was pretty neat. On Monday, I went and spoke to the business club at this small all-girls school in northern Massachusetts called Stoneleigh Burnham. And I said the same thing to them. And a couple of them came up and they're like, wait, and these are high school juniors and seniors. And they're like, wait, so I can open an account for myself today? I'm like, yeah. They're like, wait, are you sure? I'm like, yeah, you're going to need your parents to help you, right? Because it's going to be what they call a UTMA account. I think once you're over 18 or 20, I think it's 18, you can do it on your own. But yeah, and you can deposit $100 into it, and you can make something of that. And then I reminded them of the value of compounding. I didn't remind them. I think I taught them. But I said, look, if you're 16 years old, and you invest 100, here's what compounding is. And I'm going to presume your listeners already know what that means. So but that $100, if it's growing at just 7%, way below historical averages, when you're 26, it's $200. When you're 36, it's $400. When you're 46, it's $800. And when you're 56, what was I at?
800, so it'll be 1,600, right? It just doubles. Or you double.
Yeah. I just can't remember what age I was at. It was 1,600, and then 32. I'm like, so your $100, by the time you need it, can be $3,200.
Yes.
I'm like, that's serious. That's serious money once you start adding it up.
Yeah.
And I told them the story of a friend of mine too, who was a journalist. And we all know journalists don't make the big bucks. They do some of the very most important work, like teachers, and they have some of the lowest salaries. It's truly shameful. But when she started, and I think she's 73 now, because she just started taking her required minimum distributions. But she just put $10 a week away because that's all she could. And then when she could put more away, she put $25 a week away. And she just plunked it into, I don't even know what it was, a Fidelity account or a Vanguard account, but it went into one just kind of broad market fund. And when she retired, it was $800,000. That's a lot of money. It's just from doing the little bit that she could. So yeah, I think you just start, and do what you can tolerate and figure out what feels right. And some people are going to be stock junkies. You and I meet them all the time. There are stock junkies out there, and they have ants in their pants and they love buying stuff. Fine. If you're a stock junkie and you love it, buy your stocks. If you really don't enjoy it and it's tedious and you don't like the ups and downs, buy a fund and leave it alone. But do what's going to make you keep adding and persisting.
Yeah, absolutely. It's so important to start early, right? I agree with you. My audience will know I talk about it in other episodes. I got both of my kids started when they were 9, right? We set up the accounts for them. but they were 9. We tracked everything in Excel. We started with 2 stocks, and
Yeah.
this is what a dividend is. This is how you reinvest it. These are things to look for, and that's how we kind of built up from
I
there.
have a question for you though. Did it take, like, do your kids actually enjoy it and care?
Yes.
Okay, so mine don't. And it's interesting. I had dinner last night with at that Council for Economic Education thing that I was talking about.
Yeah.
And wait, I don't know. Maybe I meant to talk about that and didn't. Anyway, separately on that, I had dinner last night at an event for the Council for Economic Education, where I'm on the board, and it's this fabulous organization that teaches kids these things. And when my clients was there, and he was amazing. He was like the king of, like, I'm a parent and I'm going to teach my kids proper financial literacy.
Yeah.
Those kids, like, they know their stuff. They know that they need to do stuff, and they do not care. Or maybe they care, but they do not enjoy it. So I think it's interesting that even if you try, not everybody loves it.
Yeah, it depends.
With this level of enjoyment, like, you think some of it would rub off on my kids. Zero.
Just a quick story I wanted to share with you as well. I did this a couple of years ago. I think it was before COVID. I taught a grade 5 class. We spent about an hour and a half talking about stocks and dividends, and they got it because I don't know, they're watching Shark Tank. And so we're talking about equity, and they understood that. But yeah, it's not going to resonate with everyone, but at least you try, and I think that's a good start.
But you bring up a very important point, which is it doesn't really matter if it resonates or not. What matters is that they have the knowledge. And that's why it's worth teaching, whether you get lucky with your kids, and they learn it and they enjoy it. If you get unlucky, don't tell I said that. No. But all kidding aside, but at least my kids know.
Yeah.
And that's really important. And I think one of the bits of advice that I like to give people when they're like, I said, just accumulate the vocabulary, because at some point you're going to need it. And you don't want to be 40 or 50, and I've had this happen where, like, suddenly something happens and, maybe your spouse dies and you get an insurance thing and you need to learn it all at once. And so if you just learn, like, if you learn about compounding, if you learn about a custodial account, if you learn about an exchange traded fund versus an individual stock, if you learn 2 of those things a year, that knowledge compounds too. So if you start learning now when you're 16 or 20 or 30, by the time it might matter when you're 40 or 50 or 60, you're not jumping in to the deep end. You've got some knowledge there, and you only need 1 or 2 things a year to start to get, to build up, like, a really fundamental base. And I think it is important to know that most people don't enjoy it the way you and I do. But I also don't really enjoy eating a healthy diet, but we still do it because we know it's good for us, right? Like, yeah.
Yeah, absolutely.
I'd much rather eat cured meats and cheeses every night.
So same question, but now we're going to change the age. So now this is somebody in their mid 50s, and they've been saving diligently in a 401k, or in Canada we have the RRSP, so we're in a retirement account, and they've accumulated, let's say, $500,000, but it's all over the place. It's in bonds, it's in fixed income, it's in crypto, it's everywhere. What would you suggest to someone like that who's not happy with the level of income that they're receiving today, and they realize now they don't have 50 years to go. They've got maybe 10, 20 years when they're going to retire, and they want that income. Is there anything
so this is where
today?
Yes, but I think this is where people really, really, really need a financial advisor, like, to really be their spiritual guide, because it's a serious amount of money. You can't make mistakes, right? If you're our kids and you put $100 and you have the wonderful ability to learn from your mistakes. If you're 60 years old and you've got 500 grand and that's your retirement money, you don't have the capacity to make mistakes to help you learn. And isn't that cute? Vanguard did a study, and the conclusion of the study is that on average, a financial advisor can add up to 3% return to a client's portfolio. and they up to, right? And so they break it down into the different percentages, and almost 2% of that 3% potential return is from behavioral control. There's a little bit, but I think that situation is where you really don't want to be doing it on your own, because you at that point, there's too much knowledge that's needed, and you can't get that knowledge fast enough. You're still going to have a great experience, but then this is really important too, which is you must interview many financial advisors. I would recommend not interviewing fewer than 3. And if you have the stamina to do more, you need to do more, and you need to advocate for yourself. And it's the same as when you go to the doctor. If you can't understand what they're saying, that's not who you should work with. And if they make you feel a little bit creeped out, that is not who you should work with. And if they talk at you, like, that is not who you should work with. And if they say do this and do that, like, and it just doesn't feel right to you, like, advocate for yourself and say, like, this just doesn't feel right. And I think I'm at the stage of life where a lot of my friends, not a lot, but like there's plenty of divorce, in the world that I live in. And I think one of the really sad things that happens with women when they're getting divorced is, like, they're kind of freaked out. Things are intense, and they know they need to hire a divorce lawyer. So they go to a divorce lawyer and they start working with them. And if they were smarter about it and it wasn't as intense, they would interview 5 or 6 divorce attorneys, and they would see which one makes the most sense for their situation and who they resonate with. And they would take the time to do that. I think when you're hiring an advisor, you should think about that, because it should have the potential to be a very long run thing. And this gets back to the emotional part, which is, if you're with someone who makes you feel a little bit uncomfortable, you will freak out in March of 2020, right? And you will make a bad decision because you're with someone who hasn't been able to, like, talk to you in a functional way. And one of the things I struggle with a lot too is, most people our age are pretty well educated at this point. They've got some life experience, whether it's academically educated or life experience. Like, we've been through a lot, and we're pretty smart, and we know ourselves. And I find that like there's a lot of talking down, and just because people aren't professional investors and haven't followed the same path, like, they're not dumb. Talk to someone in an educated, serious way. Like, don't talk a million miles an hour over or around them. Don't pat them on the head and go, oh, little lady, little lady. Don't dumb it down. And if they say, I'm so nervous and I can't afford to lose anyone, you don't say, well, I'll put you all in bonds. Have a proper conversation and say, you may need to take risk. And that may make you feel uncomfortable. But when the market's terrible, we'll get through that together. And I'm going to help you get through that. So you really need to find the right person. But I think, sorry to long-winded answer your question, but I don't think you should try to do it on your own.
Yeah, no, I
And
think
you know what else I don't think you should do? Hold on. I don't think you should get, like, your nephew, or your cousin, because you're going to feel badly worrying when times are tough, and you don't want to bother them because they're busy, and they're going to blow you off because their real clients need more. In life, you get what you pay for. Like, be careful not to get ripped off, and explore that. And if you interview 3 or 4 or 5 investment advisors, ask them what they charge, and you'll start to figure out what's fair and not fair. But, like, you get what you pay for, and you should pay someone, and you should expect service, like proper service, in return.
Yep,
Was
absolutely.
that the answer you expected?
Yeah. No, it does, and I want to reinforce what you said. It's so important to advocate for yourself, right? At the end of
Mhm.
the day, nobody cares more about your money than you do, and
Right.
you,
Hold on. In the case of my clients, I do care more about their money
yes,
than most of them,
yeah,
which is maybe not healthy either, but it's a little bit of a problem. But
that's fantastic. No, that's really good. I think I was generalizing with,
no,
there's a lot of mutual fund salespeople out there, right? So
correct,
you got to
correct.
be careful about that. So you should
Well,
advocate
hold
for
on.
yourself, right?
You bring up an extremely important point there, which is, figure out if they are a salesperson or an investment advisor.
Hmm.
And those are very, very different things. And you can ask questions about how are you compensated? How much do you get for bringing in a new client? And then how much do you get in year 2, 3, and 4?
Hmm.
And it matters, and the way they respond matters. I have a good friend who's a municipal bond portfolio manager. And he said a long time ago, he said, figure out whose retirement they're managing. Are they managing your retirement or theirs? Because the real sales, they'll get a big book of business and they go from one big bank to another big bank and they get big payouts, and they're managing to their retire. They're just, getting payouts for moving their book of business. You need to be careful with that. Like, make sure they care. And there are some fabulous investment advisors. And I get to work with a lot. I mean, there's some really amazing people out there who are professional investors and professional asset allocators. And if you give yourself some time to find them, you'll find them. And if you are interviewing 6, you will figure out in short order who's the salesperson and who's the investor.
Yep, absolutely. No, that's good advice. Now, the biggest thing right now in the news, as of this recording, has been tariffs and the trade war.
Really?
And
People are talking about that? Weird.
and we've seen big drops. We saw big drops in the Dow, and and then the markets came up again, then they went down again. So there is a lot of fear and uncertainty out there. What advice do you have for investors like you and I, like investors who are investing in dividend stocks? Should people stay on the sidelines? Should they continue investing? What should they do?
Um, I think that's I think we're in a particularly difficult moment to understand because past crises haven't really been man-made. Or hold on, let me rephrase it. Haven't really been one man-made, right? Like obviously the great financial crisis was man-made. We all knew the pandemic was man-made, um, but in a different way. And so in the beginning of this one, the thought was, well, if one person can, announce tariffs, one person can take them and take them back. But what I've been saying is what makes this particularly challenging is can't really use game theory, can't really use prisoner's dilemma. When I was in business school in my negotiations class, they talked about BATNA, which is the better alternative to negotiated agreement, where you think about like which each party is coming at and what a good negotiated agreement looks like. And then you say, okay, theoretically, we want to get to a negotiated agreement. Here's what the best thing looks like. And if it doesn't work out, here's where they'll go. Can't use that, right? Because what we've got is major decisions being made on a whim, or at least that's what it feels like. And I think that might be what it really is. And so it's very, very, very difficult to navigate from that kind of big global macro perspective. And then I'll tell you what my partner says. My partner, Greg, says, when you're in moments like this, what do? We follow the process. Because the reality is humankind marches on. And if we got through the pandemic, where we all thought life was going to completely cease as we knew it, and we got through the great financial crisis, where there was a massive global financial meltdown, we know we're going to get through this. It's going to be messy along the way. And so what does follow the process mean? At the asset allocation level, means like you stick with your asset allocation. And you continue to put money to work because we don't know. You were talking before about the terrible days following the tariffs. So like April 3rd and 4th, the market was down about 10% in those 2 days. April 9th, the market was up about 10%. I did a portfolio review today with a client. The review that we sent out was as of the end of the quarter. It was March 31st. It's because of their asset allocation. But on March 31st, this one portfolio happened to be up 5%. I said, I'm so glad we're not doing this 2 weeks ago, where I would have told you your portfolio was down, but now we're up 4% on the year. And these things move fast and furious, and we do not know what direction it's going to take. So you follow the process from the asset allocation perspective. You stick with your asset allocation. You continue to put, if you're getting a big bonus now, like maybe you want to move a little more slowly, but you stick with your asset allocation. At this portfolio manager level, where you're buying individual stocks, like you control what you can control. And I'll give you an example. I added a stock to the portfolio on April 4th. and it's a company called Ryman Hospitality Properties. And they own very, very large non-gaming conference center hotels and resorts. And you can look back to the great financial crisis and see what their earnings did. The pandemic was different. That was very distorted. They couldn't have, survived that with their dividend intact. But, you can understand that business and you can see what the tariff impact on that business is, which is technically zero, right? Because it's U.S. hotels with almost entirely U.S. customers. Almost 50% of their revenues come from corporate sales. It's big, conferences being booked there on a multi-year, year after year basis, and they have huge visibility. So you can buy something like that. And by the way, it was down from about 120 to low 80s because the whole market took it down. So you can do kind of individual granular things, but like following the process is you don't panic. You don't say, oh, this time it's different. There's that famous John Templeton quote, which is the four most dangerous words in investing are this time it's different. And I think that's true. And I think the reality is each crisis is different. But what's not different is that human beings are resilient, and we're like, we march along and we continue to breathe and we continue to eat food and we continue to drive our cars and we use our ring lights that consume electricity. And, for the most part, and businesses always find a way around. It would be kind of sad if the mostly efficient supply chains, the global supply chains that have been established, it'd be sad if those were all destroyed. It's my belief that they won't be. Maybe some will get gunked up, but it seems too illogical and irrational. And it completely disrupt supply chains that worked. It's pretty stunning. Anything. I live in New York City suburb. Anything I want, anything, I can have tomorrow. Like something about that means global supply chains work. So my husband would be like, oh yeah, you want $1 million? You can't have that tomorrow. So any physical object for under $50, I can get tomorrow. Yeah. So I think you follow the process. My partner, Greg, and I, we did something funny during the pandemic, and I should see if I can actually find where this is, but we wrote letters to our future selves. So when the next really terrible situation comes along, we could go back, and be like, all right, that was worse.
Yeah.
What advice would we give ourselves? And,
Have you gone back and read did you read those letters to yourself?
No, I need to find it. It's like, but I was scared on April 4th, but I'd also done all the work months in advance on this Ryman. And I said, if it gets to $92 and it's not because the company's done something stupid, because the market drags it down, like, you buy that stock.
Yeah.
You cannot be fearful in the moment. What's that other quote? Like, be fearful when others are greedy, and greedy when others are fearful. That's part of following the process. When the market's up 26% 2 years in a row, you might want to take some of the frothy stocks off the table. Like, they're not going to 1 million. They're not.
That's right.
You're just not. You don't need to sell all of your NVIDIA, but maybe a little would have been a good idea. Like, that's risk mitigation. Like, if part of your process is when a stock reaches 10% of my portfolio, I trim it.
Yep, follow the process. So that's good advice. I got one more question about sort of investing markets, and then we'll go into talk about your book. So conventional wisdom says that when you're young, you can invest in almost 100% in equities, but as you get older and older, you should start moving away from equities and go into fixed income. Yeah. What are your thoughts on that as a dividend investor?
Okay, so do you follow Charlie Ellis's work also?
I think I've heard of him, but no. Let me write this down.
I'm surprised. I'm going to send you a book. So Charlie Ellis is a dear friend and mentor of mine, and he wrote a book called Winning the Loser's Game, which is in its 8th edition. And he also wrote a great article recently, to that 2 years ago, in the Financial Times, which references the chapter in his book that I'm going to talk to you about. But he'll make a strong argument that most investors have too much in fixed income. And what he says is they fail to look at their portfolio as really their whole portfolio. And in your portfolio is your home, right? Is your future Social Security, your wages, maybe your pension. And so I think it's better to look at what all you have. And I really, interestingly, even before I became friends with Charlie, which is well over a decade now, I thought this way. So then, when I realized like Charlie had written about it and talks about it, I'm like, oh yeah, totally. So I think here's when you want fixed income. You want fixed income if you need it to sleep at night. If you know that if you're going through a terrible time, you will not freak out and make a bad decision if you know that 10 or 20% of your portfolio is in fixed income. If that'll help you behave well, even though you're leaving money on the table, because you might only be getting 5% total return annualized in bonds, it's a small price to pay for not acting like a fool in March of 2020. You need bonds if you have a specific purchase, and you can't afford to not have the funds ready for that. Like even if it's 3 years away, you can't take market risk. Like you need bonds. I think those are the two reasons you need bonds. Otherwise, there is no version of math. None. If you have a reasonably long time frame, there's no version of math that makes bonds a good idea. Like there's just not. People, oh, well, the 10 years yielding almost 5% now. Actually, it's 4.16. But okay, it just doesn't make sense. So if they help you behave well as an investor, have at them. If you have a specific need, have at them. But I had a cool conversation with a client last week who I love. This guy is the best. He was not a professional investor, but he always managed his own before he hired me, so he could like enjoy his retirement more and not spend too much time on this. And the entire that he's hold on, how old is he? I think he's 70, and his wife is 68 or 69. So they're not quite at needing to take a retirement money out. And the portfolio is 100% in stocks. And, I said, look, I know we've talked over the years and you're totally good with no bonds, but let's do a Zoom and let's reconfirm that, And he said, and I think I have my notes here, he's like, I have my pension and it throws off this much. We have Social Security and it throws off that much. We have, what was it? There was like one other thing that throws off this much. That's whatever it was. Let's call it 150 grand. We have the portfolio that you manage, throws off 150 grand, whatever it was. That's 300. We only spend 200. Like, no, I don't want bonds. It's mathematically unsound. So for him, fantastic. And he can tolerate the ups and downs because the income's just there. So this is another one where I don't think you follow the rule of thumb. I think you do what's right for you, but you must remember that the bond math versus the equity math is never going to favor the bonds, like regardless of what some of those bond portfolio managers tell you.
Yeah, absolutely. And Tom Connolly is a dividend investor here in Canada. He's out in Kingston, Ontario. He's been retired for, I think it's more than 25 years now. And he says the same thing, right? The math doesn't make sense. And he's all in dividend stocks and has been for 50 years now.
Yeah. But I'll say one thing too, like, I've been on investment committees for two very, 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 very large portfolios, like $1 billion plus. Both, one was a family, one's an institution. Both, those kind of like 300-year time horizons. They both had, this is coincidental and predated me joining them. They both had 20% bond allocations. And you know why? Because that's like what they knew they could live with. Because for both of those, they said, if there's a terrible downturn, we feel better. Fine.
Yeah, absolutely. You got to be able to sleep at night. So if that helps, then by all means. Yeah.
And I'm like, buddy, your portfolio could drop in half. Like, doesn't matter.
Now, is that your book behind you on the desk? Do I see it there? You got a copy right there? Perfect.
Yeah, I have two of them.
So let's show that to the audience. Let's show them the cover.
I've been writing notes to clients, but occasionally I screw one up so they go into the excess pile.
Yeah. So can you show that again on the camera? We'll show that to the audience. Awesome. I'm going to put a link down to that book in our description below. I told you this before we hit record, but I'll say it to the audience here. I love the book. Every page I was just nodding. Yes. This is, it was a great read. It's an easy read, right? And it's easy to get through the entire book. And I love how you just put it in plain English. right? There's no
Thank you.
technical jargon and all that. It's just plain English, and it was a great read. So, Jenny, where can people find out more about you? Are you on any social media? I know you're a regular contributor on CNBC, so they could watch you there. So, can you give us some of those links or descriptions?
Yes, if you'd like. Social media, I'm not great on. I do almost nothing on LinkedIn, and I'm probably very annoying on Twitter. And I'm not all business on Twitter either. So, not sure if you want to follow me there. So you might not. But if you go to gilmanhill.com, there is a link to media. And my team's really, by the way, I cannot stand watching myself on camera. So my team's very generous and sweet. And they kind of curate links to like good podcasts that I've done or CNBC stuff that I've done or, articles that I've written. So that's probably the best bet is just to go to the gilmanhill.com and one Alan Gilman, and you can watch stuff there. I think CNBC did a really nice job because of the book, which I liked. Although if they're watching your podcast, like it's whatever, it's duplicative. But they did something called a Pro Talk, and it's with Dom Chu, who did an amazing job hosting it, and they just kind of flesh out. But honestly, I think your podcast, like they've seen it all. I've given you guys my best stuff so far. So thank you so much.
Okay, I really appreciate that. Well, again, I'll put the links down in the description below. Jenny, you and I could probably talk for hours
I
of
think
just
so
investing
too.
and more stocks. This has been a lot of fun, and I really am honored to have you on the podcast today and taking your time out of your busy schedule to talk to our audience. Really appreciate it.
Thank you. Thank you so much. It was a great
Thank
conversation.
you.